Hello, hello, hello. Everyone that's joined so far, welcome to the stream. Hey.
Hello, Dave.
Hello, mate. Hello, hello. We're live. We're live and ready for it, aren't we? We're live and ready for it. Let's get some things going. Let's get. Drop the air. That's it. That's it.
Here we go. Here we go.
Drop the likes. Everyone get your likes going in. Come on. There's tweets scheduled as well across all accounts. So we haven't got many viewers at the moment, but in the next few minutes, there'll be tweets going out across all the related accounts. So I expect a flood of people in the next kind of 5-10 minutes or so, right before FOMC. So let's get it. Let's get excited as well. Get excited. What are you feeling? Obviously, we've just had this little push up in the past kind of like 15-20 minutes or so to 93 and then rejection. Are you thinking we're gonna? What do you think, mate? To be fair, the fact that it's so heavily, I mean, what's it on Polymarket now? It was 95% when or 97, I think. We may. What is that? Why is Powell just come up on the screen like that? Why is Powell just come up on the screen like that?
No,
Why is he? Why is he like?
Oh no!
I almost don't want to take that off. I almost don't want to reload the window because
everyone tuning in has now seen a close up of Big J Powell.
Look at that! How hilarious!
Oh, we love it.
I don't know whether to refresh it or just leave it like that. Yeah, let's refresh the window. What a thing to happen. Yeah, so 97%. I mean, we could just get a nothing burger, couldn't we? You know, we could just get a nothing burger.
Yeah, I think for me, the really interesting bit will be the commentary afterwards, because obviously Jolts threw a little bit of a spanner into the works by the fact that it's stronger than it was, and obviously stronger than it's previously been, and the labour market. It's been a long day, but the labour market's been unexpectedly stronger than it has been, coupled with the fact that we've started to see some dissent within. There's some disagreement in terms of the voting split. So it'll be, I think the thing to watch out for won't necessarily be what they're cutting this time, because I mean, pretty much the guarantee is that it's 25% basis points, which is 97%, but it will be how they set it all up for next year, because it's looking like we may have less rate cuts next year than we expect. And the narrative that's being pushed out of the White House is obviously people saying that Trump's picking the next chair who's going to do all of this, etc. But ultimately, the chair only has one vote on that committee, and the committee, I believe, is starting to be split. There was some split at the last one, and we're starting to see a little bit more of that disagreement. I think we're getting to the point where there's some that now want to cut further, and you're going to end up with a little bit of a battle. And ultimately, the chair can't overrule what the majority of the committee vote for. Yeah, and I think the committee is becoming a bit more split.
Yeah, I think that's a good point. Is obviously everyone thinks as soon as Trump kind of gets his guy in, that suddenly, we're going to get a kind of an emergency immediate rate cut of 1%, 2%. But at the end of the day, if say his guys Hassett or whoever else, if it's actually an outsider or whatever, as long as the rest of the board members vote against it, they can't really do anything. It's kind of just all noise in it. Is the fact that as soon as Trump gets his guy in, we're going to have this and we're going to have that. But at the end of the day, if they voted against, they can't really do anything. The hands are tied. The governor can come out and maybe, and that's where it could get a bit messy. Is obviously if all this pressure is applied onto the next governor, we need to cut rates, we need to do this, we need to do that. It could end up getting quite messy if the next governor comes out and basically says, I want to cut rates, I want to drop rates by 1%, by 2%, whatever, but the rest of the board are voting against me, or these members are voting against me. obviously it has the recipe to become a bit messy, doesn't it?
Yeah, exactly. I'll have a look actually, because looking at this Bloomberg article, so we've got about the dissents. So a number of regional presidents, many without voting power on monetary policy this year, have publicly rejected further cuts. And many analysts believe Kansas City Fed President Jeff Schmidt and St. Louis Fed President Alberto Mussolem will dissent in favor of holding rates steady. So we are seeing a little bit of that split, and I think, I believe we get a dot plot, don't we, today? Because you get a dot plot every other meeting, and I believe we get a dot plot, which will be really interesting because that's basically where they forecast the rate in which they expect to see cuts, and you see the breakdown for each of the people on the committee. So we'll be able to get a bit of a grasp in terms of how quickly they see rates continuing to fall, or in this case, potentially how slowly they see rates begin to fall. And we may see a more gradual Federal Reserve easing next year, which, because ultimately the labour market numbers did come in a little bit stronger than they expected, which was then weird because we saw a little bit of a pump in Bitcoin off the back of it, which, if you're going off the narrative that rate cuts will be bullish for Bitcoin, essentially those increased unemployment numbers then throw a spanner into the works of that, because it takes away that unemployment element. We know that inflation is higher than they want, which on the dual mandate, Powell's been quite vocal in the fact that the unemployment is the more important element of that dual mandate. And so then if unemployment isn't as bad, the inflation is still sticky, you then end up with a scenario where, why are you cutting rates then? Because ultimately you don't have to. And so that question then will come into it.
Yeah, it should be definitely interesting, especially once he's actually named his guy as well. Well, once he actually names his guy, then it should be.
And you also have the bond situation, because I think there is an element of trying to be a little bit careful about what you do with bonds as in a bad place as they currently are. I think that was something I mentioned this morning, but global bonds aren't in a particularly good way, and so you don't really want to be stoking that fire, because they can get out of control pretty quickly. Just look at Japan.
It should be fascinating, especially heading into next year. But if you are with us, make sure you do drop a big like on the stream. Let's get the likes going. We've got a collective of around just over 40 people across the YouTube channels. So make sure you get your likes in. Drop a big like for us. If you're watching over on X as well, make sure you like the stream on that side as well. And get your comments in. Make sure you get your comments in, everyone. If you are, of course, new across to any of the channels as well, make sure you subscribe. Drop a sub. And we've got, what is it now? 6 minutes to go. 6 minutes to go. And Bitcoin pushed back up to 93. We're now dropping back down towards 92. We've got, the Fed's decision in 6 minutes. And then, of course, make sure you do stay on if you're watching. Don't go once the rate decision's out, because, of course, we will be watching Powell's conference at 1:30, where he gets, obviously, his speech out the way, and then of course we go into the Q&A. So don't leave until we're done streaming, because of course the most volatile part often comes during Powell's speech and of course in the Q&A, because we are basically heading into we're heading into an event where it's a 97% chance where we know the answer, and of course the market has known the answer for several weeks, especially the more that we've led into this. So unless it's not 25 basis points, there's going to be no shot to the market. Of course, the shock will be if it's 50 or if it's no change, then we should get an absolute ripple either side of the market. If it's one of the other, that would make for great viewing, and it would make for fascinating watch on
what's the market for what he's likely to say? We got that on Polymarket.
Let's see. Powell. Yeah, we do. So, inflation 40 times, 80% chance. Oh, you can actually look at that.
You can watch it on Polymarket.
You can watch it on Polymarket. That's
this is
great.
The future, isn't it, Dave?
Yeah, this is it. Look at that. I didn't know that is fantastic. So yeah, inflation 40 times, 80% chance. Inflation 50 times, 54% chance. I know he says well anchored quite a lot, a few times. Crypto / Bitcoin, 14% chance. Interesting. I mean, really, the only chance of that would come up is if someone asked it in a question. In it,
Yeah.
So if someone asked it in a question, then obviously that's when it come up. Trump, I don't think he will say anything, because every time that I've watched him anyway, if anyone mentions Trump or the Trump administration, he says basically they're not getting involved in politics. He never really names him. Unchanged, 36%. So obviously that will be, obviously if they make no change, if you're going to bet on that, you'd be better off betting on no change. On your pandemic, 51%.
Yeah, I've just done a tiny bit on him to say Bitcoin. Just
have you?
Why not?
You never know, do you? You really never know. You never know. Someone might ask him, what's the best hedge against inflation? And he might say Bitcoin. Who knows? So, yeah, there is...
Good afternoon.
Oh, we'll definitely... What's the chance for that? He normally says that,
about
doesn't he?
95%.
Yeah, I was going to say, he normally says that. That's normally the first thing he says is, good afternoon. But Bitcoin is tumbling back down now towards 92k. We've got 3 minutes to go, so everyone get excited. Make sure you get your likes in as well. Everyone get your likes in. Make sure you drop a like. And of course, like I mentioned just before, make sure you stick around, because it's not just a rate decision we're watching. We are going to be staying on for Powell's conference at hour and the Q&A. So don't go anywhere. We are here for all of it. So make sure you stick around, drop a like, subscribe as well if you're new. Get some comments in as well.
Yeah, get lively.
Make sure you share your thoughts. Where do you think Bitcoin is going as we head into the rate decision? The S&P has been somewhat flat on it, obviously on the whole day. What's it on the session?
It's been a
the
bit...
whole session was pretty flat as well, yeah.
Yeah, it's been a bit... I mean, I'm still holding on to my NASDAQ short.
Are you?
But,
we've got 2 minutes to go. 2 minutes to go. So let's see what is going to happen.
I would like to see... I don't know. I'd like to see a little bit of a pullback. But I say that because I'm lower on the higher lower. So, so I do have a slight bias.
Yeah, I am as well. So yeah, should be good fun, and we've got just 1.5 minutes to go. So yeah, do make sure everyone get your likes in, get excited, and yeah, do stick around. We've got over 50 people in now, so welcome. 60 people. If you have just joined, make sure you drop a like, make sure you subscribe, and make sure you stick around as well. We've got the rate decision in round about 1 minute, but we are on for the conference and we are on for the Q&A as well, so don't go anywhere. But yeah, here we go. Should be interesting. I mean, I'll be surprised if we get a big move based on the actual announcement. I think, if anything,
a lot of it's been front run.
It's going to come in the conference.
It'll come in the Q&A. Yeah. Or it'll come in the release of the dot plot.
Yeah. So let's see what we've got. Oh, we've got 70 people. Record-breaking viewership. Hello, everyone. Thank you very much for joining us. And we've got 35 seconds to go. So here we go. 35 seconds.
Go.
And I am going to get ready on my phone on X so I can refresh and let everyone know straight away once it comes out. What are we going to get? Let's see. Here we go. Get excited. 15 seconds. You can watch it, of course, on the countdown on the candle on the chart.
Let's have a look.
Make sure
Forex Factory pending.
Make sure you drop a like, subscribe, and stick around, because we have just had the decision go now. And what are we getting? Little movement on Bitcoin so far. I'm guessing
3.75. 25% basis point cut.
Yeah.
As expected.
There we go. So there we go. 25 basis point cut by the Fed. Let's see.
Let's have a look at what they've released.
So 25 basis point cut by the Fed.
It's a strong candle.
Here's a nice push up on Bitcoin. Nice push up on Bitcoin so far. Why is this not working? I'm trying to tweet it out and it's not working. So yeah, do get your comments in. What do you think on this candle? We are now retracing it pretty strongly. I'm just trying to tweet it out. It doesn't seem to be working. Hang on. Why is it not working? Just hang on. I will have the screen back up momentarily. Just bear with me while I go and tweet it out. Sorry for the disruption. We have got a little bit of technical difficulties on my part. There we go. There we go. All right, so that's been sent. I'll get the screen back up now. Let's get the chart back up. Of course, now we look ahead to the conference and the Q&A. Yeah, on Bitcoin, we are got a nice push up. Of course, we just took out that push up that we had prior to the rate decision, and that is big absorption on that 5-minute candle, isn't it? That is big absorption on the 5-minute candle. So we're dropping now back. We drop back below 93k.
Yeah, having a look at the release, Dave. So we had voting against this was Stephen Miran, who preferred to lower the target range by half a basis point. So we had one for, and then as we mentioned, the two who were a bit more hawkish. So we had, this is a name to chuckle at, Ostan D. Goolsby and Jeffrey R. Schmidt, who preferred no change to the target rate. So we had two dissenters for the no change.
Yeah.
And I don't believe they've released
it.
It
is. Oh, that's a nasty drop on Bitcoin now. Look at that. That is a nasty drop and a nasty 5-minute candle at that as well.
They released the dot plot.
I don't know what time that was due. What time was that due? I don't know whether that was due. Is that due at the same time or was that due later on?
I believe so.
So that is, yeah, that's a nasty 5-minute candle on Bitcoin. So we do have Powell's conference coming up in 27 minutes. So in the meantime, obviously do stick around, but go, if you need to get yourself a drink or whatever, go and sort yourself out. And then, yeah, we will be on to watch what Papa Powell has to say. Yeah. Big whipsaw on release. Massive whipsaw up to 93.2k and then all the way back down to 91.7. So basically, taking out both sides of the low time frame price action. If we have a look at Bitcoin over the past kind of few hours, if we see here, what have we had here? We come and cleared this high here, and then we come down and just took out all that downside over the past few hours as well.
So this is interesting, Dave. So just reading a headline that's come through here. So the Fed median projection maintains 25 basis points of rate cuts next year. So that's basically them saying that they think there'll be one 25% basis cut next year, which probably explains the reason why that candle is quite red, because I think the markets were hoping for a lot more than that. That's really interesting considering you've only had two dissents. You've had two dissents and you've got them saying one more. I think the market was hoping for them to at least have 2 or 3 of those 25% basis point cuts on there.
Because it's like, I was going to say, it's like you mentioned before, because what the market will also be digesting is, well, the kind of smart money in the market, they will be looking at it, not blind, and looking at it as a point of, even once Trump's guy gets in, if the rest of the board members, are kind of shifting towards holding rates higher, then no matter what Hassett says or what Trump says, they're kind of going to be stuck at the mercy of obviously getting a majority to really slam rates lower. So
Yeah, no, that's that'll be interesting because I assume that they'll So officials cut their benchmark rate by a quarter percentage point, as we've mentioned, and a tweak in the statement referring to the extent and timing of additional adjustments suggests that officials are likely to pause their rate cuts in January. I don't think that's what the orange man in the White House was wanting them to say, particularly. That's not the best if you're wanting substantial rate cuts, but it does show that they're exercising quite a lot of caution.
Yeah,
and it doesn't. And I think as we mentioned at the start, a lot of this was, I think a part of this was thrown into a little bit of disrepute when we saw the job figures yesterday, because obviously they came in stronger than anticipated, and that unemployment story is not the best. But yeah, that whipsaw is quite amusing, isn't it?
Natai Inspo in the chat, mate. We can't tell you to long or short. I'm sorry. We can't tell you to long or short. We obviously just can't give you financial advice. So if you are unsure, then obviously one option for you is to do nothing. If you are really unsure on the market, there's always that option. Leo says, what we thinking though, long or short for future? I mean, I suppose to answer that in terms of like, where could Bitcoin go from here? I think it's really simple when you actually look at the structure. So for me, these levels are kind of the key levels on Bitcoin. For me anyway, personally, you may have them drawn a bit different. The orange ones are obviously low time frame, so the ones where we could touch in the immediate future, and then kind of the white ones, high time frame. For me, these are kind of the key levels at looking at, and of course, the immediate one that we're at the moment is the yearly open, which is 93.5k. And as you can see, even yesterday when we pushed up past 94 on the daily, we still got some big absorption and rejected on the daily. Yeah. So in terms of looking at upside, what do we need to do? We need to close above 93.5k, and particularly the higher the better. The more clearance, the better. Closing like 93.8 probably isn't ideal. Really, you need to get like a solid close, maybe like 95k plus, to really cement obviously a push out of this range that we've got. But this yearly open is definitely capping it on the daily. And then from there, kind of the 96 to 97k region for me is obviously where I'd be looking at liquidity next. Again, you could definitely drag it up to there. I drew that on the 4 hour, hence why it's not perfectly on that wick there. And then of course you've got 100k, give or take, big psychological level, big number. And of course this whole region, again, you could draw this as a region if you wanted to. You could draw it from 99, maybe up to 101ish. Basically all this SR that we had on the way down, and of course extended over to the left as well. So they're kind of the immediate ones, plus the one on the downside. Yeah,
and there's some interesting macro stuff coming out of it. I'll quickly run through. So some of the immediate takeaways. So as we mentioned, the dot plot. So the dot plot remains the same that it was in September. So they basically penciled in a 25% basis cut next year, and a 25% basis and a 25 basis point cut in 2027. So they're looking at two over the next 2 years, which I think the market was obviously hoping for more of that, but it was in line with what they had previously projected. They also saw the inflation rate forecast. The inflation rate came in slightly lower than what they forecasted. So they forecasted the inflation rate by the end of next year to be 2.4%, down from 2.6%. But they've revised up some of the GDP growth. So that's gone from 1.8% up to 2.3%. So they're essentially forecasting that the economy's stronger than they previously had it forecasted, and that inflation is lower, which obviously then supports the less rate cuts because the economy is in better shape than they had previously suggested. I mean, those are the main key points. They did say that they are still open to it, and it'll be interesting to see how Powell explains this in the speech. But ultimately, this points to the US economy being a little bit stronger than we believed, which is probably why that you're seeing some strength in the S&P, etc. But that's interesting because the inflation rate is still above what their target is. Even at 2.4%, their target is 2%. So it's within their target range, but it's not at their target yet.
Yeah,
if that makes sense.
Yeah, absolutely. Coden says 55 watching. Yeah, do make sure if you're watching, drop a big like. Make sure you subscribe, of course. We've got Powell speaking in just less than 20 minutes.
Yeah.
Steve says we are going to dump. This is about WAR, USA versus Europe. A war. What are we expecting on high time frame, Carlos? Personally, yeah, I mean, I've got some levels mapped out there, so take a look yourself. I mean, basically, it's just level by level in it. So all we can do is obviously judge it by level. To go up, we of course need to break this on the daily. This will be the next area of interest, and then of course 100k. So if we break above here, I'm expecting to move into here. Again, I think probably this has good region to maybe be a case for a pullback. Maybe we come back and test that for SR, and then maybe do something like that. Who knows? That's definitely one potential. Or of course, if we are strong going into the end of the year, it could just give one big fat dirty rip to the upside. At the moment, that's where we're at, because of course we're at the upper side of this range that Bitcoin's been in. So currently, we're nowhere near around 84k where demand currently is. We're completely to the upside. So it looks like it's going to have another go potentially, unless we get bumped down.
Yeah. I saw Carlos's question: if the economy is showing strength, then why is Trump pushing Powell for the rate cut? So essentially, the economy is showing more strength than we previously had to believe. I wouldn't say it's particularly strong, and I think you're seeing that in a weakening labour market, although the labour market is weakening at a slower rate than anticipated. Ultimately, Trump judges his success based upon the stock market, which the stock market is largely driven by liquidity, and liquidity is obviously injected through lower rates and quantitative easing. Ultimately, he wants a level of economic expansion that's above what we are currently seeing. However, to get that level of economic expansion through rate cuts, you likely have economic stimulus, which comes in the form of government spending on infrastructure, and that general cash injection. It's basically two butting heads. Like Trump will naturally gravitate to wanting lower rates, so that his government debt payments come down, but also that there's more liquidity in the market. However, the economy isn't in a particularly good shape, but it's stronger than expected, which is why they are still cutting rates, but they're not cutting them as fast as Trump would like.
You've also got to remember as well is that any kind of inflation increase because of tariffs is probably only going to start showing around now onwards because of how lagging inflation is.
Yeah, you're seeing some of that. That creep in, and if unemployment claims is lower, then cutting rates will lead to inflation. The interesting bit. So the reason why you had the dissents of the two is because they believe that cutting rates will fuel the inflation. That was what they said in their notes. Ultimately, I believe that's so. A lot of it's largely being offset by energy costs being as low, because oil is quite a key driver of inflation, given the fact that it fuels the energy that makes all the production, that does all of that. But also, it's quite a key cost output in people's everyday, and oil has somehow managed to remain quite low. It's quite complex, and I'm planning on. So if you check the CSE website tomorrow, I'll be putting together a bit of a macro report outlining exactly what all of this means and sort of helping people understand the complexities of it. But ultimately, you're looking at they're saying no more cuts because they don't want higher inflation. Inflation is coming down, but it's not at the level that is in the target, and so then it's harder for them to justify cutting rates. If inflation was down at 2%, then you have a bit more scope to say, yeah, let's cut rates because we've got that inflationary element under control. But when it's above their target, it's a little bit harder then to justify doing that. And it's basically the lesser of two evils. What do you want? You want economic growth, but you also want controlled inflation, because ultimately, if inflation isn't controlled, you end up like what we had 18 months, 2 years ago, where people were paying twice as much for milk and eggs that they were previously.
Yeah. Absolutely. And look at ETH. Look at ETH. Look at the outperformance on ETH here. You've got ETH up nearly 3% on the day, up 2.2% against Bitcoin today as well. ETH is coiling up. We're now just over 3,400, heading towards 3,600, which I think when you look at the daily, or the 3-day, but particularly when you look at the daily, it's that kind of next area of interest. Definitely, in my view, anyway, 3,600, maybe up to 3,700-ish potentially if we clear the tops of them wicks. So this is coming up for the kind of next big test potentially. But I mean, the strength on ETH is there, isn't it? So Tom Lee must be doing laps around Bitmine HQ now.
Yeah. How does buying back the 40 billion impact the market? I mean, 40 billion is a bit of a drop in the ocean, but ultimately it's more the symbolism of them getting more involved in QE. The Nasdaq is going nuts, and Q is having a right little pump, as is the S&P. They're obviously liking this news quite a lot. I think it'll be really interesting because it screams to me at first glance, looking at this data, and I've not seen all of it. It depends what Powell says. It feels like this is quite a hawkish cut, and this is really symbolizing that it is that the inflationary element is now getting a bit concerning, because it's been stickier than they would have hoped for. Sticky is basically the word that central bankers use for inflation just won't come down. It just seems to be hanging on there. But ultimately it's not it's not particularly good. Although the gilt quite enjoyed it.
When do we next have CPI? When is it this month? Is it? It must be next week, surely. It's got to be next week, hasn't it? Because basically, week after's Christmas.
Yeah, we're seeing quite a cool off in the bond yields, though, which is good, because that's their big concern, is if the bond yields start going up, which I think that reduced inflation figure probably helps ease some of that concern.
Yeah. But I mean, yeah, it should be a fascinating year next year. I think it's definitely coiling up.
It's showdown. It's massive. A showdown. It will be a showdown between them.
Yeah, it should be. It should be absolutely. It should be absolutely interesting to watch. But yeah, do make sure if you're watching, drop a like, subscribe. I know there's a few new faces in here, like Carlos, Leo, a few of you guys I don't think I've seen before. So make sure you drop a subscribe. Make sure you come back to the stream, and of course, make sure you subscribe across both channels, whether you're watching on Stonksy or whether you're watching on Crypto Saving Expert. Make sure you go over to the other one and subscribe. So of course, if you're on Stonksy, make sure you type in the search bar after the stream, or on a different tab, Crypto Saving Expert. That is where you'll see a lot of Wiz's stuff, and I'll go and show you that now. Actually, let's get off this. Let's get off this. So I'll go and show you guys that right now. So of course, if you're on the Stonksy one, yeah, make sure you subscribe. Stonksy Indicator, drop that sub. But if you are on the other one, and this is obviously vice versa, if you're watching on CSE, go over to the Stonksy one. But if you're watching on Stonksy, make sure you type in Crypto Saving Expert here, and you will see Wiz on daily videos every day from now on. So he's putting out some great content, dropping a daily video. So make sure, sometimes two actually as well, isn't it, Wiz? Sometimes 2 a day.
Yeah, there's another one still to go up on here, but
yeah. So make sure you do this one as well.
Yeah, we'll be putting out a macro report tomorrow anyway, which will basically cover all of the key points of this, and I'll relate it back to what this could potentially mean, both for Bitcoin but also for general assets. Because I mean, once we've heard Powell talk, it'll be really interesting to see how the market digests it. Because as I just said to Dave, it feels like a very hawkish cut, and it feels like the market's getting quite excited when it's potentially a bearish one. So yeah, it'd be very interesting to watch.
Yeah, absolutely. So yeah, obviously I am live on the Stonksy channel Monday, Wednesday, and Friday, and videos going out Tuesday and Thursday. And you can get your daily dose of Wiz on the CSE Crypto Saving Expert channel as well. So make sure you hit both of them, subscribe, and you can come and obviously get a really nice daily amount of content. It'd be great to see some of you new guys there. What are we saying? How much volume are you waiting at Bitcoin when Powell speaks? Yeah, I mean, it'd be. I think kind of a lot of. I would assume because we've basically gone nowhere, haven't we? We've basically gone. We've gone up and down, but we've basically gone nowhere at the same time. So I think if there's going to be a move based on this event, it's going to come when he says something. You know, he's going to trigger something if there's going to be a move based on this event. If not, we may be waiting until later this week or maybe into next week. But it looks like it wants to go for this, unless this is a trap, unless this is a bull trap at the moment up here towards resistance. It looks like it wants to have another go at this yearly open. So we'll see if that comes or not. Yeah,
and it'll be really interesting. I think there's also some slight manipulation that will get played around that yearly open as we approach the end of the year. I did actually see on Polymarket, it was quite interesting. They were doing a will Bitcoin end up green for the year or not? And we are currently fighting to be green. So
yeah, we are.
It feels like it's in limbo. It feels like it's in limbo. I don't know what the odds are, but
good afternoon is now 98%. Let's see.
Yeah.
Let's see Bitcoin. Bitcoin. Yeah. What would it be called? Bitcoin. What would we get? What would we get to get it up? Will Bitcoin be green? I don't know. I don't know what we'd get to get it up. Bitcoin 2025 maybe. What price will Bitcoin hit? But yeah, I mean, yeah, the yearly candle is fascinating, isn't it? Like if we actually go and look at the yearly candle, obviously currently, yeah, we're just ever so red. When you zoom out, you obviously can barely tell, but I mean, it's a hell of a yearly candle, isn't it? It's a hell of a yearly candle. I mean, it's definitely the biggest swing in history, of course, because this is the biggest price that we've ever hit. It's definitely the biggest swing in Bitcoin's history. But this goes all the way back to 2017, and we've never had a candle like this. You know, it's always had quite a big body. Even if you look at 2019 there, when Bitcoin had a high of 14.5K and a low of around 3K, the candle body itself was still, around a third, maybe just over a third, just under a half of the actual candle itself. Where this, we could end up, I mean, who knows what we could end up with. It'd be fascinating if it closed like near enough bang on either side. Like if it just closed almost flat towards the end of the year, and it had just a couple of $100 maybe either way. But yeah, it's definitely a wild yearly candle, that's for sure. And it sets up quite nicely for next year, because obviously what you have now is you have two very clear points on this. Let me get it on a different chart. Let me get it on a clean. Yeah, this one. So what you have now, for instance, let's just say for argument's sake, Bitcoin closes in and around here with a relatively small body, which with, about 21 days to go, it's possible we may come up and, you may get a bit of a bigger body here. But what it definitely gives going into next year are two very clear points for a swing failure, potentially. So at any point we get up here, obviously looking for a peak above, and at any point it gets slammed back below, that is obviously your point to then play a swing failure pattern. And of course to the downside as well, if at any point we sweep 74K and then it reclaims it, then again, you've got good invalidation, depending on obviously how deep it goes. If it just kept going up here, then obviously you're playing an uptrend. Then if it kept on going down, you're playing a downtrend. But if it got a sweep, maybe on say the daily or whatever, then you can actually play a swing failure of the yearly candle. So it does give two very wide points, and obviously this is something that you may have, on the back burner, waiting for a couple of months, maybe half the year potentially. But if at any point we do obviously get a sweep at either end, looking for the reclaim should be fascinating. So for me personally, I will definitely have, of course, we'll have the whole all-time high marked out, but I will definitely have the low marked out as on my chart, obviously as the 2025 low, just in case we go down there, sweep it, and then obviously reclaim. But yeah, all in all, we got 4 minutes to go until Powell starts speaking. So what I will do is, hang on, I will get just let me turn this off, and I'll get the side by side. So we'll have Bitcoin chart on one side, and then we'll have Powell speaking on the other, and we will see what Papa Powell has to say. So let's do that. Hang on. Let me get rid of that. Let me get rid of that. Let me get rid of that.
So this is really interesting, Dave, that I've just seen in. So only 4 reserve banks put in requests for a cut in the discount rate, which is essentially the Fed's rate for emergency loans to commercial banks. 8 of them didn't, which seems quite extraordinary on a day where the Fed did cut the discount rate. This suggests a bigger set of opposition to today's policy decision than the 2 dissenting votes for no change. So it does feel like a storm's brewing, that there's going to be resistance to more cuts. I am reading this as a very, very hawkish cut, and it'll be interesting to see how this is mirrored for Powell. But it feels like there's a lot of people that aren't particularly keen to cut further.
Yeah, it should be fascinating, especially if there is, because what will happen is as soon as Trump gets his guy in, because there's going to be basically an agreement now with whoever Trump nominates, is under the agreement that if they can, they're going to provide big cuts. So then there's going to be basically a war in the Fed of this guy basically being, the mouthpiece for Trump, saying we need to make some big cuts now. And then, of course, probably pushback coming from the board members. So it's going to definitely cause a ripple in the Fed. And, you could see definitely a war within the Fed of whoever ends up on Trump's side as well. And then, of course, the people opposite.
Yeah, and how quickly we see the labour market fall apart.
Because you've got to remember as well, a lot of these board members have been through the rough and smooth with Powell, starting with, of course, raging inflation in 2022, the first cuts coming in March 2022, obviously riding through 9% inflation back down. A lot of them will think that Powell's done a good job, and obviously probably won't take very kindly to the comments that Trump has made about him. So, psychologically, there could be a bit of thing there of, we're not just going to do as you say just because you tell us to. So yeah, but here we go. So let me turn off the background music there, because we'll obviously have Powell speaking. If we can get it on. Is it going to load? Come on. Let me give it a little refresh. Yeah, there we go. So yeah, hope everyone's enjoyed the stream so far. And of course, let's see what Powell has in store for us. What time is it? 30. There we go. So we should have him on any second now. Should have him on any second. There we go. It's not froze, don't worry. We're just waiting for Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. there is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a 1/4 percentage point. With today's decision, we have lowered our policy rate 3/4 percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement or repo operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
So there we go. That is the conference, its speech done, and then we move over to the Q&A.
Hawkish.
statement, just to be clear, we're on the same page here. The insertion of the phrase considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending is held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have. If you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September. We've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing, but that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple of times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. You talk about in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read, but in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3 is not a big data set, but you are right about those 2 3 cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years. And indeed, the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple of things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000. So that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that this is that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part that's going on. It's also happening in the context of a temporary few month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan though.
Okay. I don't know if that means I get three questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our two goals. And so that's just unique in my time at the Fed. And I think going back a long ways, we haven't had that in our framework. Our framework, as you know, says that when that's the case, then we try to, take a balanced approach to the two things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
And there we go. That is basically probably the most interesting questions asked. The longer that the Q&A goes on, the less relevant and the less juicy they get. But there was a few key takeaways from there. I don't know about you, Wiz, but I was taking a note of them. So obviously Powell saying that everyone at the table agrees inflation is too high. Interesting quote. Obviously they're well positioned, as he's just said then as well, for a wait and see approach. So obviously wait for, they'll get December's data, and obviously there's gonna be a big discrepancy because of obviously the shutdown and stuff like that. So, they're gonna get December's data, and of course the meeting next month is right at the end of the month, the 28th. So they're gonna get January's data as well. So they're gonna get a good amount of data going into the next meeting. So they'll be well positioned for that. What else did he say that was interesting? Obviously the near-term risk to inflation tilted to the upside again. Obviously hinting that there's definitely some fear in the Fed that inflation could increase. And of course saying that they're just taking decisions meeting by meeting. And Powell as well. He never gives anything away. No. He never has given anything away. So
kept it close.
They're not gonna. They're not going to get anything out of him now. Obviously leading into January's meeting because. They know anything can happen between now and January when it comes to the data.
Yeah, I agree. And I think it comes back to what we were saying when the initial data came in. So my first glance was it felt like a hawkish Fed, and I think that's probably what we saw there. He sort of talked about how the economy is stronger than anticipated, albeit a large bit of that is due to AI spending, which I think we've joked about before, Dave, is interesting. It feels like they're waiting and seeing what happens to the labour market and whether or not that begins to decline in the new year. I think if that, he did sort of hint at if that starts to weaken, that may change their direction. But I think ultimately it's a focus on the job numbers now, I think is my key takeaway. But there were some interesting points. And as mentioned, anyone who's in either the Stonksy or the Crypto Saving Expert Discord, I will drop all of my thoughts and analysis into there. But ultimately, it felt hawkish. It'll be interesting to see how the markets react.
Yeah, it'll be interesting. And of course, you can see on the charts as well, we've had no movement on Bitcoin at all.
The S&P is moving quite strongly. The S&P and NASDAQ have digested it quite well. But I think a lot of the move will come tomorrow.
Yeah, I mean, look at that. The S&P now, of course, inclusive of futures at the turn of the day, is up 0.75%. So maybe there's the potential that we get a delayed Bitcoin move. Maybe when the market closes, when the US market closes, maybe we get a Bitcoin move then, or maybe we are just still crab market and going sideways. But thank you very much for everyone that watched. Of course, you can join Stonksy and you can join Crypto Saving Expert on either link. The link to join Stonksy is in the description. Of course, you get full access to the indicator and the Discord server. With that, you of course can join Crypto Saving Expert as well. Don't have a link for that in the description, but if you go to Crypto Saving Expert, just type that in on Google, it'll pull you to this page, and then you go across to CSE Plus, and then you can choose whether you want the Community Plus or the Premium, and of course you can pay for that on monthly or on annual as well. And like we said, it's going to drop some alpha and some good information into the Discords. So make sure you do join one of them, and it'd be great to see you in there. And of course, you can get involved in the community as well. So make sure you come and join us if you're looking for that additional information. And thank you very much. None of the servers are free, Carlos. You have to either sign up to Stonksy, links in the description, or you can join Crypto Saving Expert. So the two different products. Stonksy is an indicator and trading tool, which also has its own Discord server. And a Crypto Saving Expert is an educational platform. So it gives you courses to do on trading, Bitcoin, loads of different topics, but also has its own Discord server. Now, the good thing about Crypto Saving Expert is that you get TMG's trading challenges. So he does trading challenges, obviously, in there. You may, if you follow him, you may have seen him promote them. Also, TMG does town hall meetings for all the members as well, where basically, it's like a Q&A, and you can basically ask him any questions you want. But also, you can get direct access if you want to Wiz for anything, macro and traditional finance as well as crypto. Also in there, just obviously, it is an absolutely amazing group of traders too. So, if you want just trading discussion all day and to talk about setups and to talk about the market and everything, then, Crypto Saving Expert Discord is definitely the place for you. So yeah, type in Crypto Saving Expert on Google, and of course, just come over to the Plus tab, and then all the information is there for you to join Community Plus or Premium, and you can pay monthly or annual. Obviously, it's up to you. But yeah, thank you everyone that's joined. Been a pleasure. Hope you enjoyed it, and of course, make sure you sub, make sure you like on both pages as well, and we'll see you all soon. Bye for now.